let's move to this next technique, and it's called the mixing bowl. It says use mixing bowl technique for free stepped up basis. Okay, here I want to just deal with the concept of this because I don't want to get into the weeds of this. This is very tedious if you get into the weeds. But the concept of this is that, let's say you've got one family member who owns an asset that has a low basis. It's like a building that he's depreciated down, or it's a stock that he bought when it was real cheap and now it's grown to a big value. So he holds this asset that has a high fair market value, but has a very low basis. And we all know that if he sells that asset, there'll be a tax on the gain. And let's say you have another family member that has a high basis asset. And the fair market value of these two assets are about the same. But again, one has a low basis and the other has a high basis. And let's say that this high basis asset is one that the family thinks it's not going to ever sell. Let's use as an example a bond portfolio that the family's just going to hang on to, or some legacy real estate that the family's got, a ranch or some real estate the family's not going to sell it, at least not while the current generation, the mom and dad, are alive. So you're sitting there with a high basis asset that you don't plan to sell, and another family member has a low basis asset that one day you probably would like to sell, but you'd have to pay tax. So this mixing bowl partnership is a way to shift basis and basically allow you to take the high basis from the asset you don't plan to sell and move it over to the one that has a low. And then you take the low basis and you move it over to the other one that you plan to keep. And the way you do this is you and the family member that owns this other asset, y'all form a partnership together. And you each put your asset into the partnership. And if you wait 7 years, you can then engineer this thing to swap the basis on those assets. 7 is in the tax code. The tax code actually says you have to wait 7 years to do this. But if you'll wait the 7, you can swap the basis. And therefore, at the end of 7, you can now have an asset that you're about to sell that all of a sudden has a high basis. And you sell it and you have no gain. And the other asset that you're going to hold has a low basis, but you don't care because you're not selling it. And on that low basis asset, the one that you're going to hold, if you hold it till the owner dies, you get a stepped up basis. So again, if you hold it till you die, there's a step up. So you didn't care that it had a low basis because you get it cured by having someone pass away and get a stepped up basis there. So that's the bottom line of this technique, is shifting basis. So again, the facts are these, and then we can kind of move forward here. But the facts are these. You've got one asset owned by a family member with a low basis and another asset owned with a high basis. And the one with the low basis, you'd like to one day sell it, but you don't want to pay tax on the gain. If that's you, here's a technique that would really be appealing. The taxpayers we're talking about here could either be you and another family member, or it could be you and a trust.
Right, and you might already have assets in a partnership. One of the points is to, number one, when you're doing planning, it's important now to look at using partnerships and making sure you don't mix investment partnerships with partnerships that are a trade or business.
Right.
So the example that Marvin had that I saw is that, let's say you have grandfather and he's got $1 million piece of real estate, he's depreciated it down, it's in a partnership. And then you got son one, puts $1 million of bonds in, like Marvin was saying, right? So his basis in the bonds is, let's say, $1 million. The grandfather's basis in the real estate is 0. Son 2 puts in $200,000 in cash. His basis is $200,000, right? The thing that's interesting here is grandfather wants to sell the piece of real estate, right? And let's say the real estate's been in the partnership for 7 years now, he wants to sell the piece of real estate. He cashes out son one with the $1 million piece of real estate. The son that put the $1 million of bonds in, he gives him the real estate in return for his partnership interest, right? His basis in that real estate is $1 million. He sells that fully depreciated piece of real estate for $1 million, no capital gains tax.
Exactly.
What's left in the partnership are what? The bonds and the cash. Well, now, Grandpa's basis in the partnership is the same, 0, but if they make an election when he dies, those bonds will get a step up in basis, and nobody will have paid any capital gains tax on any of those assets.
You got it. And there's charts that show all
by
this.
mixing, that's why he calls it a mixing bowl
bowl.
partnership. So when you're starting to invest, and doing income tax planning, it really is important to look at your entities and what you're putting in these different entities. You can get dramatically different tax results, okay, by doing this. And everybody benefits.
Yeah, and there's
except the
all
IRS.
different ways to engineer this thing. I mean, we're just
Right.
giving you one example, but
One
you
simple
can
example,
get
right.
very creative.
Right.
And in the charts that you have, I'm going to show you that what Bruce just talked about is illustrated in color charts here. And if you can come flip forward a few pages, you'll see where dad, son, and daughter enter into a partnership. And that's the facts that we were just talking about.
Right.
And it walks you through all the steps. This first one was partnership formation. The next chart was how does this thing look when the son now gets removed from the partnership. And then the next chart is what happens when the dad dies. And then the next chart is what happens when the partnership sells the bonds. And then the next chart is what happens when the partnership dissolves. I'm not going to walk you through all of that here, but it's here. And you can walk through it later. But the bottom line is, at the end of the day, the family was able to sell a low basis asset, pay no income tax, and then later, because they held on to this other swapped asset until dad died and got a step up, they ultimately sold that and paid no income tax either. So you never paid income tax. Yeah, you had a question.
Right.
Is the structure in these partnerships very specific in how it has to be done? I mean, is it tricky to set up and very questionable?
Yeah, you got to do it right. And I will tell you as a tax lawyer that the tax code, which of course is ridiculously complicated, if you ask me, what'd you say?
Taller than this room.
Taller than this room.
Yeah, it is.
Yeah, and we now have a new 1,000 pages to learn. But the thing about it, that partnership tax provisions, if you ask me what's the most complicated part of the tax code, I would tell you it's the partnership tax provisions. They're the most challenging of all, so you can really slip up. But if you do it right, and again, I didn't put all the traps in here. There's plenty. But if you do it right, this works. You just got to be dealing with somebody who really understands partnership tax. And frankly, that's not every CPA or every lawyer.
No.
You just need to, it has to be someone who's an expertise in that field. But thanks for asking that.